of fair value and face value. Unless the loan amount either bears interest at commercial rates or the loan account is capable of conversion to an interest-bearing loan, the fair value will be below the face value. Now, what I suggest you do here is that under the terms of settlement of the loan account, the board of Shelfco, a holding company of JOCO, is to be given a qualified discretion to call up all or part of the outstanding balance of the loan account at any time. I'll come to the qualification to the discretion later. But for immediate purposes, what you need to focus on is that if the board of the holding company in its discretion calls up all or part of the outstanding balance of the loan account, that call is not satisfied within, say, 5 business days of it having been made, then the amount thus called up, or the balance of the amount thus called up, will bear interest at commercial rates, say prime plus 2%. So you have a mechanism for the ready conversion of an interest-free loan to a loan bearing interest at commercial rates. And that should suffice to align the fair value and the face value of the loan account. Okay? As regards the solvency test, the solvency test in Section 4 of the Companies Act calls for the company's assets as fairly valued to at least equal its liabilities as also fairly valued in the wake of a dividend declaration. Now, we have an issue here which arises from aligning the dividend amount, the loan account liability, with the goodwill inclusive net asset value of JOCO. We have an issue arising from the fact that we are having regard to the fair value of an off-balance sheet asset. Can you, in deliberating on solvency, for the purpose of the solvency test, fairly have regard to an off-balance sheet asset? That question arises from the requirement in Section 4 of the Companies Act to the effect that a board of a company, in deliberating on the satisfaction of the solvency test, must base its deliberation or its determination on financial statements complying with IFRS in the ordinary case. Okay? Now, under IFRS, you will know that self-created, self-generated goodwill, as opposed to purchased goodwill, will not be reflected on the financial statements. I don't think that this is an impediment to taking account the fair value of goodwill if you apply an appropriate method in determining the fair value of goodwill. The fair value of goodwill is commonly arrived at by applying an appropriate multiple to net profits after tax, NPAT. Now, NPAT you can glean from the financial statements. And if you use the approach involving an application of multiple to NPAT, then yes, your fair valuation of goodwill will ultimately be based on your IFRS compliant financials. Okay? It is not a figure in the air. It is not a thumbsuck. It is based on your IFRS compliant financials. So yes, depending on the valuation method, I am of the view that you can legitimately have regard to the fair value of off-balance sheet goodwill in determining satisfaction of the solvency test. Okay. As regards the liquidity test, the pertinent provision here is Section 46 sub 4 of the Companies Act. Section 46 sub 4 says that when a distribution effected by a company takes the form of the incurrence of a debt, yeah, then the liquidity test is to be applied, yeah, at the time of the incurrence of the debt, and only at that time, and not again and again every time the debt is subsequently discharged or partially discharged. So you need only look at the impact on liquidity over the 12 months immediately following upon the creation of the loan account liability. Okay? Now, in order to facilitate satisfaction of the liquidity test, we will import a term into the terms of settlement of the loan account. We will qualify the discretion of the board of the holding company to call up all or part of the outstanding balance of the issue price by providing that the holding company will not, over the 12 months subsequent to the creation of the loan account, yeah, exercise its discretion to call up all or part of the outstanding balance of the loan account in such a fashion as to impede the capacity of JOCO, the debtor company, to settle its debts as they arise for settlement in the ordinary course of business. It is that qualification to the discretion of the holding company's board to call up all or part of the outstanding balance of the issue price, which would then facilitate satisfaction of the liquidity test. The holding company may not, in the initial 12 months, yeah, call up all or any part of the outstanding balance if, in consequence, it is likely that the subsidiary company will be unable to meet its debts as they arise for payment in the ordinary course of its business. It's a very important qualification to the terms of settlement of the loan account. Okay? That approach is, I think, the key, the most effective key, yeah, to the establishment of black workers' trusts. Its application is by no means confined to black workers' trusts. Yeah? It has a ready application also to senior executives' share schemes, where you want to issue shares, yeah, for nominal consideration to your key executives. Yeah? I think it's vital that you do understand the approach. If you have any questions, please raise them. When I get no questions, I'm never quite sure whether there are no questions because I've explained everything with abundant clarity, or because I've only served to confuse you. Which is it? Is it a bit of both? The important thing about that approach is there is no debt at the level of the Black Workers Trust. You get your 8 out of 20 points on the ownership scorecard immediately. It has advantages for both the stakeholders, generally white stakeholders in the company, whoops, and the black workers. Through the creation of the loan account entitlement, in effect, the current owners of the business are being paid out the value of what has been established by them. Yeah? And that serves to overcome that resistance which stems from a perception that if you implement black co-ownership, you are inevitably involved in a giveaway. Yeah? From the point of view of the black workers, it's a marvelous investment. If their trust comes to hold, say, 25% of the shares on issue in the company, the black workers collectively, it's going to cost them nothing, will participate in 25% of the future growth in value of the company. It's a riskless investment. Nothing required out of their pockets. Yeah? What you would typically do in such a case is the company will donate 250 rand, let's say, or 25 rand, a sufficient amount in any event for the trust to take up a 25% shareholding in the company. It's important, and I should emphasize this, that the trust acquires its shares not by way of a transfer of shares, but by way of what is now a subsidiary company issuing shares to the trust. An issue of shares is expressly under paragraph 11 of the 8th schedule, not a disposal of an asset or assets by the company. If in contrast, you would have the holding company transfer shares in its subsidiary to the trust, you could have tax issues. Tax issues because there are anti-avoidance provisions dealing with so-called dividend stripping maneuvers, where preparatory to a sale of shares, you pay out a dividend with a view to devaluing the company. But significantly, this does not culminate in a share sale. There is not a dividend strip. It culminates in a share issue. From a treasury point of view, from a SARS point of view, I think it should be appreciated that this approach constitutes the single most effective way of conferring equity on black people. Okay. Succession and some of the detailed terms that one advisably imports into a trust set up for a black employee share ownership plan. Before doing so, I should perhaps explain my perspective on things such as these. I am primarily a commercial lawyer. My principal interest in what I'm about to unfold and some of the other arrangements we will discuss today lies in the drafting of the attendant documentation. When I speak to accountants about structural arrangements, I can sense that in the back of their heads they are going through the associated accounting entries. When I listen to an arrangement being sketched, what echoes through the back of my mind are the key terms of the necessary agreements that I will have to create in order to give flesh to the arrangement. So you're getting a commercial drafter's perspective on what you need to do in the course of establishing a black workers' trust on advantageous terms. And by advantageous, I'm amongst other things concerned with simplicity of administration. The running of this trust should not be a considerable burden upon the resources of the company. Okay. I want to sketch for you first an approach that I would never recommend to clients. That approach is, in fact, the conventional approach to trust-based employee share arrangements. What is conventionally done is that you unitize the trust. You unitize the trust in the sense that your eligible beneficiaries are issued units, and the value of a unit is tied to the value of a share or to the value of a specified number of shares. You staple your units to the shares, if you wish. It is also conventional then to provide that on the termination of employment, for whatever reason, the units are to be redeemed. Your departing employee is to be paid out the value of the unit. Now, as I explained in passing earlier on, the difficulty with this conventional approach is the trustees will have to create a redemption reserve. They will have to hold back dividends received in order to fund future redemptions. And the need to maintain an adequate redemption reserve may severely inhibit the capacity of the trust to effect annual dividend distributions to serving employees. Yeah? And you end up, as I said earlier, principally rewarding those employees who leave you rather than those employees who stay with you. Okay? In order to obviate exit payments, I would do two things. I would firstly define the beneficiaries of the trust to include black full-time employees during the currency of their employment by the company. Now that phrase, during the currency of their employment by the company, has an implication. The implication is that there is no entitlement on the part of the beneficiary to share in trust distributions once you cease to be employed by the company. You simply cease to qualify as a beneficiary without any need for an exit payment. Yeah? What is further done is that one provides in the trust deed for the capital of the trust, the shares in question, or the proceeds of a sale of the shares, to be distributable to, or to vest in, if you like, those employees who are in the service of the company at the time of the termination of the trust. Yeah? So it's only if you are amongst that generation of employees, yeah, who are in service at the time the trustees resolve to terminate the trust, that you will qualify for distributions of the trust capital. Okay? There's a deferred vesting, if you like. And it's the deferred vesting, yeah, coupled with limiting your qualifying beneficiaries to serving employees, that obviates the need to make any exit payments when an employee leaves the service of the company for whatsoever reason. And the arrangement then enables the trust to make a full distribution year on year of dividends received, net only of expenses involved in the administration of the trust. Okay. As regards the allocation of trust distributions, if simplicity and ease of administration is a primary objective, I suggest that you provide for dividend participation on a simple per head basis, so that if employee X is one out of 100 serving employees, employee X will receive 1% of dividend distributions. If fairness, equity, and the encouragement of long service is a priority for the company, you might allow for dividend participation on the basis of the beneficiary's number of completed years of service over the total beneficiaries, yeah? All the beneficiaries' completed years of service. So if you've completed